Blue Owl, who are they? Where are they in the investment world, private markets, private credit world? And what's the significance of the news today?
So it's a good question. We talk a lot about Blue Owl, and Blue Owl loves to make a lot of headlines. So it is important to reorient our listeners as to what is Blue Owl and who are they. It was formed as a venture. It was a tie-up, a merger between Owl Rock and Dial. Owl Rock invested in a lot of middle market companies, say companies in the $50 to $200 million EBITDA range. They need loans. Regional banks were pulling back. They didn't necessarily have the capital easily available to them. So if there were people willing to step up and say, we're ready to do the due diligence, we're ready to do the credit work and lend to these companies, Owl Rock discovered there was a market for it. And Dial was a company that was investing in secondary stakes for a lot of these private capital firms. When you merged the two, you had the formation of Blue Owl, which in the last 4 years since the merger, has become sort of a proxy for the private credit market, because as the demand for such players has grown, as their capital has become far more important, and as they've been flexing their muscle, Blue Owl is certainly at the forefront of it. And the people behind Blue Owl, you have veterans from Goldman Sachs, Craig Packer, Lipschultz from KKR, you have Doug Ostrover from, erstwhile GSO/Blackstone. So these are really smart people. So when we think about the private credit market and try and get a sense of how it's doing, we look at players like Blue Owl. They have truly positioned themselves as the leaders in that space.
Well, speaking of mergers, that brings us to what happened earlier this week and why we saw shares decline. On Monday, there was set to be a merger between two of its private credit funds. Now it has called that merger off. Why in the first place would Blue Owl want to combine two of its private credit funds?
And look, it's just such a self-inflicted wound. And, truly, this isn't something extraordinary or something that never happens. A lot of their non-listed vehicles, this was a private vehicle for a lot of high net worth individuals to gain exposure into private credit markets. Eventually, as a means of getting liquidity, you either take that vehicle and take it public so that people can trade in and out of it, or over the life cycle of that fund, after its defined life ends, you just wind it down. You get the principal back. You've been paying out the interest as dividends to your shareholders. And when you get the principal back, you could wind down the fund. Now, Craig Packer was talking about it this morning as to when the idea was originally seeded. This private vehicle, OBDC2 that we're talking about, for high net worth individuals, and the public vehicle, the much larger public vehicle that does exist, OBDC,
right?
They had a lot of overlap, and pretty much these funds had almost identical holdings, something like 98% overlap. And when they initially thought about this merger, the public vehicle was actually trading very close to its book value. So it wouldn't have mattered a whole lot. The board would have easily approved it. The shareholders would have easily approved it. But the timing, the decision to announce this just a few weeks back couldn't have been worse, because you are suddenly telling investors in an unlisted vehicle who could trade in and out of that on a quarterly basis at book value, and Blue Owl had been honoring all those redemption requests all this time, that they now move into a publicly traded vehicle.
Which is discounted, right?
Which was trading at a 20% discount. So when the FT initially reported about this, they were absolutely right. On day one, you have a 20% paper loss, and no one's going to like that. And that was the problem. And it comes at a time, and we talked about the Jamie Dimon cockroach comments. Remember the loudest critic of Jamie Dimon right after that comment?
I forget it.
It was Blue Owl. It was Lipschultz talking to our very own Danny Berger, and even without Danny mentioning Jamie Dimon, he took a swing at the big bang, saying that the next problems in private credit, next problems in the credit market are not going to be in the private credit firms. It is going to be at the banks. So with those headlines in the near past and what's happened now, it's not a good look. It is a bit of a black eye.